joining this webinar at this time. And this webinar today is about investing in the middle of rate hike. And a lot has happened since the past week. We did a session before this regarding mega trends and futuristic investing in areas which are very popular right now, but still a lot of scope for growth and improvement. And those areas were related to cybersecurity. Those areas were related to water distribution companies, renewable energy based companies. And this is what we did in the last session. And I see a lot of known names. So welcome to the ones who have attended my webinars before, and to the new crowd, most heartily welcome. I'll try to make this session more and more productive for you. We have a live platform as well where we can go and see the actual prices also. Before I begin the session, if you can hear me properly, if you can see my presentation, please send me a yes or a okay so I can proceed further. Just to know that everything is just working fine. I don't want you guys to miss out on anything. Okay. Perfect. So a lot of you have replied. It's okay. So I'm just taking the majority over here. Anyways, the recording of this session will be uploaded on YouTube, so you don't have to worry about it if you're missing it out today. So how normally we conduct these sessions is you have your chat options available, and while I continue to do the session, if you have any questions, try to ask those questions, and I'll try to answer them while we are doing the session, or at least by the end of the session. Definitely, if there is something which I cannot answer, then absolutely our team will get back to you with a proper answer. And the whole idea about doing this webinar is to generate more and more awareness about what's going on in financial markets and what are the areas you can probably invest into. A lot of research we do depends on what's going on now and our understanding of what is expected to be in the future, depending on the current market movements. That being said, whatever is going on currently or whatever has happened historically in the past, it does not always mean that it's going to repeat it. But our best guess is always that if this has happened in the past, let's try to learn from the history and try to create something which is going to be more effective today and in the current future. Risks are always there. So while I say please, whatever stocks or whatever opportunities we are going to talk about, until you consult it with your risk expert and measure your risk according to it, please do not take this as investment recommendations. It's really, really important because we're going to talk about a lot of companies, about a lot of stocks. We're going to talk about a ladder portfolio. We're going to talk about a few dividend-based companies which you can look into. But every investment contains a sufficient amount of risk. So please talk to your risk experts. Check your own risk appetite before you invest into any of this. Now, just to tell you what has been going on currently with the financial markets, an immediate question came that before you start, if you can just give us a snapshot of what's going on with the current markets and what has been the scenario like. So off lately, what we have seen, just to start with oil, probably because it was a lot of in news. If you see today, I mean, yesterday oil prices went up really high, but then if you see today or compare it to yesterday afternoon, oil prices have come down a bit. It's a kind of wait and watch move. What happens to the sanctions and what happens with Russia and Ukraine? Whatever the sanctions which have been put so far on Russia, it has kind of underwhelmed the commodity market. So there is an expectation that oil might breach $100 per barrel also, and that is why it is more important to keep a close watch on the oil prices. The Russian banks, which are heavily involved with the commodities industry, nothing much have happened to him because we have seen commodities of lately prices going up. We're going to discuss about what has been going on with gold also. Um, Germany has already announced. So these are the updates from the Russia-Ukraine issue, which has been going on, because there is no point of me talking about, the rate hikes, which is obviously going to happen. But then, what is the current market scenario? We completely get lost in the current market momentum of what's going on now. So Germany has already announced the suspension of the Nord Stream 2, that the natural gas pipeline, and there has been not much reaction to it, but that's an important pipeline, which also underlines the idea that what's going to happen between Russia and Ukraine, because um, the there are pipelines which goes through Ukraine, and the understanding is that Russia is not going to block that pipeline by attacking on Ukraine, and that was one thing which was the idea which was talked a lot about. US has floated the idea of a globally coordinated crude stockpile release, because Russia-Ukraine tensions are still alive and the sanctions are being put. As of now, on the current war scenario, we have seen that Russia has moved more troops and equipments to the western Russia and southern Belarus, if what has been seen from the satellite images. Now, for the traders, uh, if you are looking for support and resistances for oil, for US oil WTI, $90 a decent support, $93 a kind of resistance. For Brent oil traders, support will be around 94.5, resistance will be around 98.5 levels. So this is something which has gone in oil, and please continue to write your questions if you have any, and we'll try to answer those questions as well. The Russia-Ukraine issue is a very current issue that has pushed gold prices also higher. So talking about gold prices, what has been going on with gold right now? Um, so hovering around a price of 1895, because and the price of gold at this point of time heavily depends on the Russia Ukraine issue. Now, what we have to understand over here is the markets for now seem to have viewed these sanctions which are imposed by the US. So US, UK, Europe, they have put sanctions on Russia. Now, how much are these sanctions going to impact Russia? That is one thing. If we see all these Western nations, they have warned already that they are ready with more sanctions if Russia carries out a full-scale invasion of Ukraine. So now this is concern number one, right? And then there is another concern, which is the rising inflation, right? Because with rising inflation, we see oil prices continue to go higher, and then there is a lot of geopolitical stuff which is going on. So that combined is pushing gold prices higher. As I said, that Germany has already stopped the Nord Stream 2 pipeline in response to the Russia's move, and that has brought oil prices very close to the $100 mark. Now, gold itself, if we see, it has gone up by around 5%, because gold as a safe haven whenever something like this happens. And this has happened before. Russia-Ukraine crisis have happened before. And that time we saw Russian ruble, the Russian currency, going off the charts. We saw gold prices going higher, and this is happening again. So, as a safe haven, gold prices have already gained around 5%. Now, we come back to the rate hike, let's talk something about inflation, because now, since we have seen the stock markets, what has been going on with the stock market? So that was gold for you, and now when we look at the stocks, um, there's a lot of pressure on the stocks, because the short-term bond yields. So when we see the difference between the yields of a 2-year bond and a 10-year bond, when it started reducing, and when we see the spread, it has reached to a very lowest point since April 2020. Now, it's not a very good news for the stocks. And if you see back in the past, whenever S&P 500 whenever has S&P 500 has come down, that has been the result of, I mean, one of the most important causes has been the flattening of the short-term bond yields curve. Now, that is one thing. And then we are talking about a very, very aggressive stand by Federal Reserve to increase the interest rates. For those people who are new to this, when we say increasing the interest rates by Fed, that means the US central bank is talking about increasing the cost of borrowing, which overall in a macro perspective reduces the supply of money. And because credit becomes more expensive, borrowing becomes more expensive, inflation is controlled. Right now this attempt is happening because of the inflation. And a lot of analysts right now on Wall Street, they are debating whether Federal Reserve might announce an emergency interest rate hike, because recently the labor data which was released, it showed inflation around 7.5%. Why this number is really, really significant, guys? Because this is the highest level in 40 years the US has reached. So now there are global political tensions. There's a lot of uncertainty. S&P and Nasdaq, if you see, S&P is down by almost 8% for the year. Nasdaq is down more. So Nasdaq is the index which focuses more on technology companies. So it's a tech-heavy index, and that is down around 13.5% for the year. So if you see a large number of shares, and especially the tech ones, what we call them the growth stocks, they have been under a lot of pressure. Banking and financial stocks, these are they basically started the earning season in the January. The performance have shown it has been good, and a lot of people are still betting for the financial stocks. So today we need to understand a few things about what has been going on with the federal funds rate. Now, there has been around 3 rate hike cycles. Back in 1990, we saw one which was between 94 to 96. Then there was 2004 to 2006. Then there was 2015 to 2018. And every time when there was an announcement, we saw bond yields reacting. So if you see a comparison of the 10-year bond yield, and you see the federal funds rate, whenever the news of the rate hike comes in, the yields, they get really, really volatile. But it always gets adjusted when the actual rate hike happens. But volatility, it continues to happen. So that is one of the most important things we need to understand, because if that is the case, if volatility is expected to continue like this, then we can see a lot of movement in the market, and especially in the stocks as well. But in most cases, it has gone back close to the levels. The bond yields have gone back close to the levels where it was before the rate hike. But again, as I said, that this is what historically has happened, and to understand the impact of rate hike on your portfolio, you have to understand how it has worked out before. Now, important part: how many rate hikes are expected to happen in 2022 and 23 combined? So there is a number of 7 to 8 rate hikes. When I say 7 to 8 rate hikes, that means how many times the borrowing rate will be increased. So it will be 1 or 2 or 3 times, and as per the current understanding by a lot of fund managers and analysts, it is expected to be around 7 to 8 times. So important thing is how many times it is going to happen. Another important thing is by how much percentage points is going to increase, right? There have been, so because inflation is so high, so a lot of momentum is now being gained that whether Fed will increase the rate by 25 basis points in all the 7 meetings, or it will do it step by step. Now, just to take examples, previously what happened in 94 to 95 rate hike. So as you can see on the slide right now, Fed raised 7 times between 94 to 95, and 3 times in 94. So Feb 94, March 95, April 94, 25 basis points. 3 times they did by 50 basis points, and 1 time by 75 basis points. Just to give you an example, if central bank rate was 3%, then when I say 25 basis point increase, which means increased by 0.25%. So from 3, it became 3.25. As you can see, between 94 to 95, when 7 rate hikes happened, 3 of them were increase of 25 basis points, 3 of them were increase of 50 basis points, and one time they increased by 75 basis points. Now, during the rate hike cycle, the 10-year treasury continued to increase the trend to reach the peak before reversing the trend to decline by December 95, close to where it was before the rate hike cycle. So, what we have seen in all these rate hike cycles, that initially the bond yield they start rising, and once the rate hike happens, and by the end of the cycle, we see the bond yields coming back. But most of the time, what investors expect and what happens, so you see the blue line, which is different from what what had investor expected, and the black line, what actually happened with the rate hikes. Look at 2004 to 2006, from 2004 to 2006 as well. So we have seen Fed has increased the rate 17 times. And look at that, 25 basis points 17 times, 5 times. So 5 times, 8 times, and 4 times. This is how it happened between 2004 to 2006. And all the 17 times, they just increased it by 17 basis points. For most part of 2004 to 2006 rate hike cycle, same thing. 10-year treasury yield fluctuated before finally crossing the 4.7% level, which was in the beginning of the cycle, to reach the highest, and then reversing the trend back to when it was before. So same thing you will see between 2015 to 2018 as well. So this is something which historically we have seen, that most of the time the rate hike happens by 25 basis points. The probability of that happening by 50 basis points. So in the market, a lot of talk is about whether the rate hike will happen by 50 basis points or more than that. Currently, when we see this possibility, there is a lot of talk about it, because there was a probability that Fed might increase it by 50 basis points, and given the current inflation also, it might happen, because it's a kind of urgency, right? Because we see overall stock markets seem very bearish, seem very downside, and that is not just because of the Russia-Ukraine tensions. That is the reason, that one of the reason is that inflation has continued to increase, and there's a lot of speculation about how Fed is going to react on it, right? Now, from the investors' understanding point of view, so now what I'm here to tell you today is there is going to be an impact on your portfolio of stocks. If you don't want to invest into stocks, that's again your idea of investment. But the point is that whenever rate hike happens, not that the entire stocks drop, there is always a sectoral shift. So mostly we have seen that during the rate hike cycles, there has been a gradual shift from the technology stocks to the value-based companies, to the value stocks. And that is really important, because the growth stocks or technology stocks, their earnings are why people buy them today, because they're expected to grow in future. So their returns have to be justified with, if you are getting that a certain amount of return by just putting into a bond, then why would you invest into a growth stock? Your expectation increase. So there is always a sectoral shift from the growth stocks to the value stocks. A lot of investors, they prefer value stocks in the rate hike cycle over the growth stocks. Now, this is a list of some UK companies, and most of them are related to financials, and some of them are related to energy, utilities, consumer staples, all those areas where normally investors would go during a rate high cycle, which normally investors would prefer during a rate high cycle. And we should not forget. So before we start just looking at these stocks, let's try to understand the impact of the rate hike on a couple of things. If we are looking at some sectors, bank and insurance firms, they could really see a sharp improvement. Now, currently the short-term yield has gone up. So we were just reading about, I just started about telling you that how the short-term bond yields still continue to go high and the curve is getting flattened. It has gone way higher than the long-term bond yields. The 2-year bond is yielding way higher than the 10-year bond yield, and that's why the curve between the both is becoming flatter. Right now, that probably, as I said, that once these rate hikes happen, there is a time when starts reversing back. So that could change in the coming quarters, and especially when the Federal Reserve, they start reducing balance sheet, and again everything starts getting back. So insurance company, a lot of insurance company can see their profits rising because they will be able to invest those premiums into high yielding bonds. Another set of business, when we are looking at companies with very strong brands, who, because they have very good pricing power. So when inflation is there, in an inflationary environment, uh, the companies with strong brands, they're able to raise prices and they protect their profit margins, because these are brands we are talking about. Let's take an example. um, Take example of Hugo Boss, for example. If somebody buys from Hugo Boss all the time, it doesn't matter whether it is, if the price increased by 5% or 6%. If you're a brand conscious person and that's the specific brand you buy, you're gonna pay that. So the companies with very strong brands, they have good pricing power in an inflationary environment. These could be the companies which will raise their prices, protect their profit margin, right? Um, a lot of technology stocks, I feel that investors still should avoid, especially with the high valuation. The ladder portfolio I'm going to show you will have some technology companies in it, but then it is a division between a lot of different sectors, from conservative to moderate to aggressive. So not all the tech companies are bad, but few companies with a very overvalued or high valuation, I think, should be avoided for the distant future. Um, because when long-term bonds will rise, the future cash flows will get discounted at a higher rate. So basically, when we are looking at spaces like EV or early stage fintech kind of a companies, those companies will get affected a lot. Um, Anyone who's trading or investing in gold, because of the Russia-Ukraine issue, we have seen gold prices going higher. Otherwise, in a strong rate environment, I have said this before, even in a few sessions when we were talking about outlook for 2022, uh, gold forecast among all the analysts was always with a very bearish tilt because of a very aggressive rate hike. A lot of people were bullish on dollar, expecting a stronger dollar and a weaker gold price. Because of the Russia-Ukraine issue, we have seen gold prices going up higher and higher because of the safe haven quality it has. However, there is a strong resistance for gold near 1900 or 1920 levels. Support, the most strongest support, if it comes down, $1680 is a very strong support. Because of the recent market volatility, geopolitical concerns surrounding Russia and Ukraine, it has kind of boosted demand for gold as a safe haven. So this particular year and for the couple of months, maybe it remains range bound. So a lot of us are changing their outlook from bearish tilt to a very range bound look, right? Depends on how this is going to impact, how the Russia-Ukraine issue is going to impact. So gold is expected to remain in a range bound. Market pullbacks will happen, and that is why a lot of investors are looking into gold as well. Strong support at 1680, while there is resistance around 1900 or 1920 levels. Right now, coming back to companies which belong not which not which don't belong to the growth area. Now these are companies which are value based companies, and these are the companies with attractive dividend also. Why I'm starting with the UK companies, because since this is the first 30 minutes of the session, so I see a lot of people still there. So just want to make sure that you get this right, because ladder portfolios will eventually be sent to you by your relationship managers. This was some research what we were doing. Now, so this is specifically how would you invest into a rate hike environment with increasing risk of rate hikes by central banks globally. markets expect to remain volatile in the near term, and investors could be moving to the high dividend yielding stocks, as I was talking about, that how investors they prefer value stocks over the growth stocks. Growth stocks do not give you dividends, but value stocks they give you good dividends as well. And currently, looking at from the dividend tax point of view and everything, UK is offering the best average dividend yield companies. Uh, should note that as compared to 2019, in 2020, there a lot of dividend were cut down and reduced. Uh, what could be the reason? Use your chat options, guys. Just think about a lot of UK companies. They cut down their dividends in 2020. In 2019, it was 110 billion. In 2020, it was 70 billion. The average, the dividend which was being distributed overall by the UK companies. Why there was this sharp decline in 2020 for the dividends? Because then it started again raising. Now 2021, the total dividend distributed was 94 billion. In 2019, it was 110 billion, but in 2020, it was 70 billion. What do you think could be the reason? Use your chat option. Should I take a wild guess? Okay, 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 okay. Great, great. So I think a lot of you actually got it right. I'm still waiting, still waiting. Okay, okay. So yeah, so the majority, what the answer everybody said was that in 2020 we saw the pandemic. Um, Pandemic leads to it led to a lockdown, and when lockdown happened, companies were not able to generate enough profits, and the only way to sustain in that kind of environment was to cut down their dividends. So a lot of companies during the lockdown they cut down their dividends, and the companies which did not, they kind of suffered also, because what happened was, uh, take example of ExxonMobil. ExxonMobil was one company, uh, was one of those companies which did not cut down the dividend at all. And ExxonMobil is a oil company, if you're aware about. And ExxonMobil did not cut down their dividends. And what happened was during the pandemic, uh, ExxonMobil they invested a lot. They did a lot of capital expenditure to expand, and there was a lot of investment done by ExxonMobil, and then we saw oil prices getting negative as well. So with in a lockdown environment where the supply was in abundance for oil, and a lot of capital expenditure done by Exxon, they did not cut down their dividends, which kind of raised the question that where the dividend is coming from and how it's going to affect the health of the company, and that triggered short selling for the stock, and we saw Exxon prices going down a lot. So that was one of the reasons that a lot of companies in UK they reduced their dividends, and it was around 70 billion. And now in 2021, by the end, we saw that dividends have again gone up to 94 billion since the economy has reopened. So if you see these top few dividend yielding stocks, so a lot of these stocks, some of them have dividend yield of 12%, 7%, 6%. And when I'm talking about these dividend yields, this is of course yearly, that you hold the stock for 1 year to complete the dividend cycle. So companies like Rio Tinto, companies like Imperial Brands, Anglo American PLC, British American Tobacco, Vodafone, Aviva, National Grid, British Petroleum, Shell. So British Petroleum has always been a better choice as compared to Exxon, because at this point dividend tax in UK is also less as compared to US. So if you're looking at diversifying your portfolio in the middle of this whole rate hike time, these are few companies which you can look at. Again, as I said, please talk to your risk experts also about this. This is not a suggestion or recommendation right away. Yes, these are some companies which we are currently looking at. Looks promising from a dividend point of view. If you look, most of their 5 years return, the volatility is not much, right? So if you see the negative returns for a couple of companies in last 5 years, British American Tobacco 5 years annual performance, I think 2% down. If you look at Vodafone, for example, 0.6% down. However, increase, if we have seen around 27%, 7%, 4%, 19%, cut it down to yearly returns, most of the yearly performance are in double digits. And these are the companies which are not really volatile. So if you're looking at year till date performance and or a 1 year performance, it is still a very significant number. Should we always expect these kind of returns? Absolutely not. We should never. Uh, but the idea of investing into these companies is not uh, to look that how they have performed in 1 year or 3 years or 5 years. Mostly to see the sector which they belong to, which is the value sector, not the growth area, and plus the amount of dividend they are giving. So that being said, this is one of those strategies which you can look into. Second thing, what I want to discuss about was within this inflationary environment, if you're looking at a stocks portfolio, there is something called a ladder portfolio which we have created. And ladder portfolio requires investments in the three tranches: phase one, phase two, and phase three. So when stocks came down off lately, phase one kind of started, but then the phase two and three should happen when stock further declines to a very strong support level. So for those investors who don't understand how support level works, which means if price reaches, say, Facebook price goes $200 and it has gone to 200 6 or 7 times and touched 200 and bounced back, touched 200 and bounced back, touched 200 and bounced back, which means it has created that strong support level for Facebook that every time it touches 200, there's a massive buying and bounces back. So phase two and phase three buying should happen at right support levels. So I'm going to share this ladder portfolio. If you have a notepad with you, can write it down, or you talk to your relationship managers and then they will definitely share the ladder portfolio with you. Uh, right here. So if everybody can see this, please use your chat options. If you can see this, send me a yes, okay, something. So I know that you can see this properly. You can take a snapshot of this later also, or talk to your RMs and they will definitely send you these ladder portfolios. But as I said, that whatever stocks are mentioned over there, please talk to your risk experts first and only then go for anything else. Now over here, look at this ladder portfolio. So this is in response to the aggressive policy set by Federal Reserve about increasing the interest rates. Federal Reserve, world's most powerful central bank. Basically, it's U.S. central bank, and a lot of things hover around U.S. Market expectations for rate hikes have surged rapidly to 5 this year alone. And as I said, the probability whether it is going to be a 50 basis points or 25 basis point, that is something which is there. Tapering, rate increases, balance sheet reduction. So Fed is ready to use everything it can to cut down inflation, because as I said, 7.5% inflation rate, this has been the highest in 40 years, right? So when something like this is happening, as it is written, it comes no surprise that markets have suffered significant blows this year. Nasdaq and S&P gone down 17%, 12%. Now, when we are looking at the laddered portfolio, as I said, the word ladder itself means that we are looking at different phases of investment, right? We are not saying that this is the bottom and stock's going to go up. So as it mentions that the path ahead is definitely slippery for the markets. Stock might witness a further pullback, and especially now when Russia-Ukraine issue is going on. But then a lot of times we have seen that take pandemic pullback, right? There has been, when pandemic stocks crashed, a lot of investors started buying even in the pandemic, and stock markets went up. So when, if you're looking for a buying opportunity over the long run, because 2022 is the midterm election year also, we should not forget that. And every time we have seen in midterms, mostly the stock market pulls back on an average of 16 to 17%. Now that's a really, really important fact, guys, right? So let's say if you're looking at this three phases laddered portfolio, where phase one, say, continues or starts now, which is the current market price, and the second and third, which happens at a proper support levels and market falls, right? We identify proper support levels, and then you can probably look into it. This portfolio is divided into aggressive, moderate, and conservative components. So for those investors who are very aggressive, for those investors balanced and conservative. So this entire portfolio has all the three components in it. Index is the part of the moderate risk, right? Around 15% will be allocated to S&P 500, Nasdaq, and the small cap company based index. And if you see the very snapshot of this, look here, for example. Okay, so just I'll give you a moment to take a look at the companies. From an aggressive point of view, as I said, that I am not completely discarding the tech companies. Yeah, so somebody just wrote over here, why is called the ladder portfolio? Because so basically ladder portfolio, when we say, because it is in phases, you mentioned it, right? 40, 35, 25. Idea is very simple, for you to invest into tranches and not at once. Today you buy a stock, tomorrow Russia-Ukraine crisis worsens. So if you have $500,000, the idea is not to put all 500,000 at one. You put 40% first and then see where the market goes. If it comes down, breaches to a good support level, then enter another 35% and then another 25%, till so your entire investment gets completed in three ladders, and that is why we are calling it. And especially in an interest rate environment, so we are putting this three approaches right there. In the aggressive approach, we are putting stocks like Adobe, Nvidia, Estee Lauder, Salesforce, Amazon, Airbnb, Boeing. See, just to give you a small description, of course, when you sit or try to buy these, and when you're doing research, it should be more extensive and not, just fundamentals. But something like Adobe, for example, Adobe is looking, it has already created a space for itself in the creative zone. All the softwares, all the important softwares related to video editing or anything is provided by Adobe, and it is kind of dominating that space. It is also getting into marketing areas where Adobe is able to provide its services. So not only these are the companies which are poised for a future growth, but then these are not the likes of Teslas or Metas or something like that, right? Something which is a lot more volatile. So even in the aggressive ones, the companies which you see are the ones which have a history of growing slowly. Now, a company like Nvidia, for example, Nvidia fell a lot of lately. But if you see Nvidia is one single company, one of those companies which is expected to get benefit out of the Web 3.0. For those who doesn't know Web 3.0, Web 3.0 is this third generation of internet which creates a kind of decentralized platform for users. So currently, right now you don't have control over your data. Your data is used by 5 most important companies. They are only holding your data: Apple, Facebook, Amazon, Google, right? These are the top tech, the big 5 which are holding your data right now. With Web 3.0, you get to control your data, that who sees it, who not. So it's a very decentralized kind of a platform. And when something like this happens, or metaverse, for example, Nvidia is a company which already creates graphic chips. And if you talk about NFT, you talk about metaverse, you talk about Web 3.0, this is a company which is expected to get benefit from all those sectors, right? So look at Nvidia from a very futuristic point of view. Salesforce continues to acquire Slack Technologies and Monday.com kind of companies. So Salesforce also is one of those important companies. Even in the pandemic, where most of the tech came down, actually, sorry, most of the tech went up, but even in the work from home companies like Zoom, at one point it went up and started coming down. But if you see Salesforce.com, it has continued to go higher. Amazon.com, needless to say, the company, it's a cash rich company, and at the same time, Amazon is making a lot of money in its cloud computing segment. And cloud computing is something which, because of the pandemic, there has been a COVID induced progress in that area. A lot of companies from their specific base are able to execute a lot of operations using cloud computing, right? So because of the remote lifestyle and work from home approach, some of the companies, they are still on the list and still doing well. Companies like Airbnb, Boeing, for example. Boeing, the 737 Max is now cleared. The Chinese airlines stations have agreed to start the order, and this probably could be the year for Boeing to recover. And plus, uh, Omicron, fortunately, is not as bad as it was thought initially. So, again, it's a reopening stock as well. And then we are looking at some moderate companies. We're looking at JP Morgan, Bank of America. Financials, especially financials. Why? Because in a rate hike environment, you would want to invest into financial companies as well, because their profit margin as well increases. So you're looking at JP Morgan. JP Morgan is one of those companies that during the pandemic still, so JP Morgan has different segments. There is commercial banking, there is private banking, there is wealth, and all of these areas performed well in the pandemic also, and it turned out to be one of the best stocks to invest in. So then there is Starbucks, there is Walt Disney, and then we have ExxonMobil. So ExxonMobil has recovered from its lows and still is able to provide a promising dividend. Plus, oil has started going higher, and it continues to remain higher, reaches $100 benchmark. So we have put ExxonMobil also. Looking at a conservative point of view, we have put companies like, again, very value based companies. I'm looking at Verizon, Walmart, Coca-Cola. A lot of them give decent dividends, less volatility. It's defensive sector. Basically, defensive sector is the one which is, even if the recession comes in, it's basically non-cyclical. So for conservative investors also, there has been put something. Um, Look at the bifurcation of this, and this is important here. So portfolio was created for $500,000, but then it's up to you, whatever money you have, how would you dedicate and divide this? So basically, the first tranche is the 40% tranche which I was talking about. That's entry level one. And even out of that 40%, you put money 30% into the aggressive scripts which we just saw, 35% in the moderate, and then even in moderate comes, along with the companies which I said, the indices also come into the moderate, and then 35% into the conservative. So over here, equal weightage is given to moderate and the conservative area, but depending on your risk appetite, you can always tweak it. That is up to you. Talk to your risk expert, see how it works out for you. Entry level second will have 35% of your investments, in which, now see how it tweaks, because the entry level two, why 40% is allocated to the aggressive ones? Because when we are looking at entry level two, we're expecting probably prices have come down further. And for the aggressive companies, so aggressive are the growth ones. So if it has come down to a support level, the idea is it might go up also faster. So 40% for the entry level two. And if you see entry level three, the same weightage becomes 50% for the growth, right? So as I said, guys, depends on your risk approach also. The best idea is always to talk to your risk experts and ask them that how should I plan it out. If investing was this easy, investing is very easy, but to plan it out is what takes time. If I just send you this flyer today and you just start buying with the same percentage, it may not make sense for you, because you have not even assessed your risk appetite. Something which is conservative for me could be aggressive for you. An amount which is small for me may be big for you, or which is big for me could be smaller for you, right? So you have to talk to your risk experts, talk to one of the consultants, which probably we have, and he will give you the right idea, or she will give you the right idea of how this would work. Just a brief idea. So this is a sector-wise allocation, again, stock-wise allocation in the indices. A bit description about how of all these stocks they have worked out. Adobe, as I said, focused on creativity and customer service. All the industry leading applications, Photoshop, Premiere Pro, cloud, e-signature based solutions is provided by Adobe. From paper based to digital documentation. So even during the pandemic, a lot of our clients had to sign some declaration forms, and that was done through e-signing or hello signing or e-signature kind of apps, and Adobe was the very center point of it. So Adobe has provided this experience through the clouds, and they are getting into the marketing as well. And that is something, marketing automation is one area where Adobe is becoming a leader, right? And to the end, management estimates 150 billion market opportunity by 2023. So again, guys, looking at it from a very long perspective, in the middle of the rate hike also, we are not going for the very known Teslas, and so we are keeping this FANG thing away right now, except the Amazon in it. Just looking at few tech companies which have been doing good for some time. Same with Nvidia, as I said. We talk about metaverse, talk about Web 3.0, talk about a lot of these things, and Nvidia is one company which is expected to get benefit out of it. Even if you see, I heard about how Dubai is going to come up with driverless cars, right? So a lot of these processors, AI processors, which are used in supercomputers, data centers, they will be used in self-driving cars, and it is created by NVIDIA. NVIDIA is the leader for this. And NVIDIA has invested a lot in metaverse as well. So again, not that metaverse is just right at the door, but whenever it happens, NVIDIA will be ready with the hardware and the software to support the developers. So that is again one futuristic company we are looking at. Then there is Estee Lauder. There are, so all of these companies, right? When we are looking at Airbnb, for example, or Boeing or Salesforce, for example, these are the companies which you can look at even in this environment. So not investing in stocks is never a solution, right? Why? Because even if you only invest in bonds or anywhere else or just property, you still have to diversify. The idea, every investment manager, every analyst who always talks to the investor, you always have to diversify. Getting out of the stock market because this issue is going on or that is going on, that is never going to be the solution. If there is no rate hike, probably growth stocks are better. If there is a rate hike, value stocks are better. If there is uncertainty, go with the non-cyclical companies, or go with high dividend yielding companies or defensive sectors. But when you're investing, one thing which you have to make sure that uh, there should be a proper diversification allocation up as per your understanding of the risk, right? And this is just one of those strategies, right? Something which is completely different from the stocks portfolio thing. Even if you are trading in commodities or investing in commodities, there is a strategy called seasonality analysis. Now, seasonality analysis is something where we start assessing 10, 15 years of a trend of a commodity. Seasonality analysis happens a lot in commodities. Let me just share my tab with you. So seasonality analysis happens normally for the commodities. We have done for sugar this time. And the idea of seasonality is very simple. And find out the 10, 15 years of data, and then look at their monthly performances just to identify that which month has been the best or the worst, and see if there's a pattern in. Um, so we back tested this, and there is a sugar seasonality analysis which we have come up with. And just look at this. This is the performance of sugar in last 15 years. And what you see is mostly in the month of March, we see a lot of decline every year. Most of the time in the month of March, we have seen sugar prices falling, right? Let me just zoom this for you. It's right here. 8% down, 26% down, 29% down, 10% down. There is a sort of pattern developing here. Yes, there have been 3 times when it is positive, but then look at the negatives and how many times it has been repeated. So looking at the seasonality. Now, price of sugar often reaches its lowest point between March and May due to the fundamental factors of weather and harvest cycles. Low point coincides with the peak harvest in Brazil, world's largest exporter of sugar. Harvest results in nearly a full year's worth of supply coming to a market in a short period of time. So the influx of this supply causes the price of sugar to decline to the lowest point in this cycle. So this is something, if you see maximum positive, it has gone at 6.9%, but maximum negative is 29-30%. So probably an idea where you can short sell sugar. Now this is apart from what is going on with the rate hike, what is going on with Russia, Ukraine, that's completely separate, right? So when you are investing, a leg of this could go to seasonality based strategies. And it is something which is really smart because this is away from the market noise. It is just the seasonal part of it. Not necessary that you have to exhaust all your savings into it. But as I said, what you're doing right now also as an investment is good. But these are just few ideas which you can explore with your risk manager and see if this is something which can work out. Right? So there are a few questions over here. Okay. So how can we access these strategies? So by access means how you can execute these strategies. Okay, see, execution of the trade is done through the platform, which obviously is the later on stage once you understand. So the next step is always talk to your relationship manager, get these strategies, understand how that works, and then probably go for an investments account to do that. But before even the trade happens, you should understand that how this entire strategy would work. So that is the whole idea of doing these sessions, just to show you that these are few things which have been going on, and how would you invest into these kind of strategies using different examples. Okay, so there are a few more questions over here. Please continue to write the questions. Now I'm able to answer since you're at the end of the session already. So we can definitely answer this. Okay, so what's your 12-month view on 12-month view on? I think the question is not complete yet. Mr. PSV. So you asked me about a 12-month view on 12-month view on what? The markets, on commodities, on currencies, and what? Okay. A 12-month view on GBP. So see, so we started with an outlook for GBP USD outlook for 2022, and that time UK did not increase the interest rates. So when we were even talking about the forecast, again at this point of time, everyone will mostly have an outlook which will be neutral to bullish, I should say. Basically, the intraday traders, they are booking their profits at 1.37. The bearish traders, they are basically booking their profits around 1.335. The reason is most data published off lately, recently, whatever data has come up, it has painted the picture of the British economy, which is really, really amazing right now because home prices have jumped. We should not forget the fundamentals also. Home prices have gone high, record high. Inflation has also spiked to the highest point in last 30 years. Labor market is also strong. So if inflation goes up, it will be worse if employment was not there, right? But the point is, the GBP USD, even in this area, it still remains high. Ukraine crisis still going on, but then there are positive economic numbers. Houses have continued to go high, even in the middle of the inflation, which is 3 decades high. Labor market is still strong. If you see the retail sales in January, it has increased, right? If you see the manufacturing data of the service provider, it has gone up. And the data which is coming right now is better than what it was before. And this entire strong performance, somewhere there is a lot of optimism that UK is moving to the right directions, right? um, Manufacturers are very optimistic. Supply challenges, obviously now the pandemic is there, so the biggest part is a lot of sectors have reopened easily, and this is expected to only get improved as of now. So most of the people in UK, they already have been vaccinated. There are no, I mean, restrictions have reduced as it was before. So the economy is getting really strong. They have done a rate hike also, and they will continue to do the rate hikes as well. So even this year, there are expected rate hikes from the Bank of England as well, right? Right now, the key catalyst, what we see for GBP USD is the current crisis which is going on in Europe. Because if invasion or this Russian invasion happens, then probably we might see pound coming down a bit, because then dollar becomes a safe haven. Everybody starts investing in dollars. But then if that doesn't happen, then probably we see a stronger forecast. So that is something which is, I should say that the view should be neutral to a bullish tilt. How I said about gold last time, that with a very bearish tilt I'm looking at, but right now I think we should be neutral with a very bullish tilt for GBP, seeing that how this Russia-Ukraine crisis shapes out. Jyotish, to summarize, go for value stocks, not growth, during the expected rate hike, ladder method, seasonal options. Exactly. So these are a few things which you can look at. And as I said, please talk to your RMs. They will really help you out. So we do these webinars solely for the purpose of information. These strategies are nothing else but a source of information. So I would never sit here and tell you, okay, here's the strategy, now just trade. Never. You look at this and see if that is your investment style at all. If you're doing something different, why not? But talk to your RMs, talk to our consultants. These are some brilliant minds who are in the company, and they are working day in day out, finding out research only to cater you. So whether a client or not, please talk to them and see if this is something which can work out with. The risk is in everything. Please, let's understand this bit. Nothing over here is risk free. Uh, if we survive 2020, then we should understand that risk is something which will be in the air. So even if you cross the road, you don't see left and right, you're risking your life with it, but that doesn't put you back in the house. If you have to control your losses, you have to do the right kind of strategies, plan your downfalls. What happens if it comes down? What is my plan B? That is the way to invest. There is nothing which is going to be risk free, right? Before I leave this session, a big word of thanks on behalf of my family and my company, my team at Century, to all those people who have been a part of healthcare industry, first responders, nurses, doctors, midwives, who have risked out their lives in these years of pandemic, and they continue to do it for us. I really, really appreciate it, and I want to thank you from all my heart. If you have such people, if you are one of those person, a big word of thanks. If you know such people, if you have friends, relatives, spouses, or children who are working in that area, I would love to extend my thanks on behalf of my entire team, my family, to them. I wish them a great, great health. So if you have any doubts, you want to have a one-on-one session, I'll be happily available. Even the relationship managers will be there with all these portfolios. You can talk to them. And if you like this session, please go on Century Financial Google reviews, Century Financial Consultancy Google reviews. Please put your feedback. We want to continue to do these webinars, and we do these free of cost just to spread more and more information. So if you like my session, my name is Yogesh. Please give a feedback on the reviews part, and please encourage us more to come up with more and more topics. So again, next week there will be a different person. There will be a different topic. March onwards, there will be different people doing different sessions, and the idea of all the sessions will be very simple. The strategies we'll be discussing that are built for your comfort. So talk to us more. My name is Yogesh. Thank you so much for giving your time. Have a great night.